What's your take on that, Professor Siegel, the size of the pullback and the persistence of it? 3 weeks in a row of declines.
I think it's healthy. I think that the NASDAQ and the tech got way overbought, and it's a healthy correction. I mean, we don't even have a correction, I don't think, in the S&P. NASDAQ's down more than 10%. S&P less. Value stocks are just down 1 or 2%. I think it's basically healthy. I mean, September's a tough month, and NASDAQ, listen, the whole market had one of the greatest rallies in its entire history. A breather or a correction is certainly nothing unexpected, I think.
Steve, we did see quarter expiration, options activity. Anything strange going into the close that could have impacted the way we finished?
It was actually more orderly, Sarah, than I expected in many ways. This morning, we didn't really see much of a ramp one way or the other when the futures and the futures options and the index options expired. And going into the close today, there wasn't anything that I would call out of the ordinary. There was huge open interest, but so much of that was in call options that are now way out of the money that it was a relatively orderly expiration, considering the magnitude of the quarterly expiration and the magnitude of the open interest and just overall interest in options that we've seen this quarter.
Mike, that expiration, what does it mean for the month ahead, the week ahead, if those call options have expired, whether in the money or out of the money, the fact that they've expired, and there was just so many of them over the course of the last couple of months?
Well, historically, the week after a September expiration has a net negative bias. I mean, not dramatically so, a little under 1%, I think, is the average over recent years. But it should mean perhaps that the market can start trading in a back and forth way a little more on corporate fundamentals. Not that it hasn't been, but I would point out that, as Steve says, this absolutely massive volume of call options that were so far out of the money, what that means is the lopsided public buying of individual stock call options to play further upside was just obliterated, right? So in other words, you had all this premium bought by the public that just went away. And so you wonder if that's going to change forward-going behavior at all, at least in the short term.
Nancy, you said you were taking the opportunity to buy some of the names that you like. Are they value or are they technology growth? And does it have to be an either or?
No, it doesn't, Sarah. We are value managers, but I guess maybe more growth at a reasonable price. So I remember the last time that value outperformed for more than 3 weeks, and that was 2017 when we had global synchronized growth. We may get that again with the strong PMIs, but we've been adding to both. We've barbelled the portfolio, so we have added to some of the tech, but we've added to some old economy names as well, and then really just spread out our exposure, overweights with healthcare, consumer discretionary, industrials, and technology. So we like names that pay dividends and grow the dividends, but we're also willing to step in where there is no dividend if we think future, growth is being purchased at a reasonable price.
Professor Siegel, if the NASDAQ and tech names got overbought, to what extent were the cyclicals underbought, and have they closed that gap yet, or are they still attractively valued for the long term?
Closed at about this much. We had extreme between the growth stocks and the value stocks really last reached in 1999. Before that, probably the Nifty 50 craze of 1975. It's a 20-25-year period. I think value will outperform over the next year with the reopening of the economy and the search for yield because, the Fed told us rates are going to be zero. People are going to migrate towards, I think, the dividend-paying stocks, saying, where else am I going to get yield? And I think those two argue for finally growth outperforming in 2021.
So which type of value outperforming? What kind of stocks? Are you talking about banks, which haven't really fully joined the value rally like an industrial group or materials group? Which ones are you eyeing?
Well, I don't particularly recommend sectors. I mean, I think the financials are hurt. First of all is, what's commercial property could be permanently impaired, probably will be in value. And so much banks are loans against the small businesses, of course, which don't have stocks. They're reflected in those banks. So those are the one. I mean, one could think of those in the entertainment, in the airline industry. Some of those that might do better going forward. But I think actually those that have yield and are not have threatened yield are going to be ones that people are going to be looking at in the next 12 to 18 months as interest rates stay at zero. And we know Treasury bond rates also at 0.5%, not anything that you can get your income out of that you'll need. So I think there will be a migration into those sectors. We have the election coming up. We should mention that. And I think that's going to keep uncertainty on the table for the next 2 months until that